evening and welcome to the 14th Annual Pershing Square Challenge. My name is Meredith Trivedi and I'm the Managing Director of the Halburn Center for Graham Endowed Investing. While this is the 14th annual event, it's only our second time hosting it completely online. We're once again thrilled that so many of you were able to tune in to hear the great work of our students, and we certainly hope to all come together in person for the 15th annual event in 2022. Thank you to Julia Kimiagarv, who not only coordinated all of the logistics related to this evening, but who also managed most of the logistics related to the Applied Security Analysis class throughout the semester. Thank you to Professors Anurup Duggal and Michael Herman for teaching the Applied Security Analysis class and for going above and beyond to get the students to this point. Thank you to the judges, many of whom have participated year after year. It's an incredible opportunity for our students to present in front of investors of your caliber. And of course, most importantly, thank you to Bill Ackman, whose generosity has made this event possible for so many years. The Pershing Square Challenge is an absolute highlight of the academic year, and Bill, we are truly grateful for your support. With that, I'll hand it over to Professors Herman and Duggal.
Thank you, Meredith. Good evening, everyone, and thank you for joining us for the 14th Annual Pershing Square Challenge. As many of you know, the Pershing Square Challenge is a culmination of applied securities analysis. This is my third year teaching the course, and it's the second year I've taught the course with Michael Herman, who's my co-professor. The course consists of about 75 students who team up in groups of 3 to develop a stock pitch over the course of the semester. We had about 25 very strong stock pitches this year, and it was a very difficult decision, but 5 of them were chosen to compete in the finals today. The 5 finalists this year, in alphabetical order, are Angie, Avalera, Blackline, Dolby, and Pegasystems. Congratulations to these 5 teams for making the finals today. We look forward to hearing your pitches. The format of tonight involves each team presenting their pitch for about 10 minutes, and that'll be followed by about 10 minutes of Q&A from the judges. Once the 5 pitches are complete, the judges will meet for a short deliberation, after which the winners will be announced live. We hope you all stick around to see who is chosen as the winner this year. There are a few people we wanted to thank for their efforts in making the course an enriching learning experience. First, Tano, Meredith, and Julia from the Halburn Center. They are vital to making the class a success, including arranging mentors and fun visits for all the teams. Thank you guys for all your help throughout the semester. Michael Herman, my co-professor, the TAs, Mark Hu and David Winslow, all the funds and mentors who help the students develop their pitches. The judges, we appreciate all of you making the time to join us today. Tegas Research, who I guess for the first year were gracious enough to provide each team with 4 expert network calls. And this was really unique. This provided the students with invaluable sort of experiencing what primary research calls are like, and definitely improved the quality of the pitches that you'll see today. And finally, but most importantly, the students for all the effort that you put in throughout the course. You know, one of the favorite parts of our teaching is really to get to know you and meet you guys in person. And unfortunately, we're not able to do that this year due to COVID. And I know for the students, having us teach from our living rooms is definitely less than ideal. However, we thought the quality of this year's pitches was one of the best we've ever seen, and we hope that we'll be able to meet you all in the fall once the vaccines are fully rolled out. So this is the second year that we're doing the competition virtually, and it's looking reasonably likely that we'll be able to do this in person next year. However, looking at the glass half full, there are 2 positives of doing this online. One is that we have a very large turnout with over 1,000 viewers signed up to watch, which is great to see. And second, as you may have seen last year, we have all the judges sitting at home with Bloomberg at their fingertips. So this allows them to ask much tougher questions to the students, although it's debatable whether the students view this as the glass half full. So we like to end each class with a few investing lessons and have a couple parting thoughts for the final class of the semester. The past year has been one of the most dramatic years in the financial markets. If experienced with a teacher, you could probably say the last year would have been a PhD class. The markets dropped over 30% in less than a month last March and have since proceeded to rally over 80% during the following 12 months, reaching new all-time highs. We have seen unprecedented monetary and fiscal, unprecedented policies from monetary and fiscal authorities. We've seen the Fed increase the balance sheet $4 trillion. We've seen record low interest rates globally, trillions of fiscal stimulus from governments, and asset prices increasing significantly. I thought it was sort of an interesting sort of point that it may be a sign of the times that last year, when we looked at the average stock pitch in the class, they had an average valuation of 15 to 20 times earnings. This year, when we look at the average stock pitch in the class, it had an average valuation of 15 to 20 times revenue. I would like to think that this highlights the continued evolution of thinking around value investing in terms of taking a longer-term view and selecting high-quality businesses with large growth runways, but perhaps this is also indicative of the current market environment. Joking aside, though, I think the students have done a really good job highlighting why something that may seem expensive on the surface may actually be a bargain. And I do feel very good that Columbia is still sticking to its value investing principles, as there was no cryptocurrency, SPAC, or pre-product billion-dollar companies that were pitched in this year's stock competition. So given the extreme moves that we've seen in the market over the past year, I think this may also be a good time to remember Ben Graham's lesson that in the short run, the market is a voting machine, but in the long run, it's a weighing machine. On that note, I'll add one interesting anecdote. Just for fun, we poll the students each year in class, asking them where do they think the market will be in the following 12 months. So last year, with the S&P around 2,800, the majority of the class thought the market would be lower. This year, with the S&P around 4,000, the majority of the class thought that the market would be higher. I think this just goes to show that predicting near-term stock prices is very hard, and this is why we teach the importance of taking a longer-term view at Columbia. I would like to end by wishing all the students the very best for the rest of your time at Columbia Business School, and it was a privilege teaching you all this semester. I would now like to turn it over to Michael Herman, my co-professor, to say a few words about the competition and introduce our sponsors for the evening, Pershing Square. Thank you.
Thanks, Anurup. And I'd also like to thank you for another great year of teaching together. So I'd like to take this opportunity to introduce our generous sponsor, Pershing Square. Bill and his fund need no introduction, as they're one of the most renowned activist investors of our time. Pershing has been a very generous sponsor of the value investing program, with this being the 14th year of the Pershing Square Challenge. I myself participated in this challenge back in 2015. And the reason I'm not saying even nicer things right now is because I came in third place. For Bill, I'll never forget. Joking aside, the Pershing Square Challenge was started with two main objectives. First, to develop the next generation of value investors, or as Bill likes to say, the next generation of his competitors. And second, to get students to start thinking about philanthropy. Traditionally, the winning teams donate a portion of the prize money to charitable causes of their choosing. So on behalf of Columbia Business School and the Heilbronn Center, I would like to thank Bill and Pershing Square for their support, time, and mentorship to the program, and for providing a real-life example of the importance of philanthropy. With that, I'd like to pass it over to Bill to kick things off.
Okay, great. So thank you for that very nice introduction, and a few thank yous of my own, but I'll be very quick so we can get to the prizes. First of all, to Professor Sermon and Dougal, if I did not have the opportunity to have real live practitioners teach me the investing business. I went to Harvard Business School, and they still don't have a particularly good investing program. So Columbia has a real competitive advantage, and a big part of it comes from the kind of the lay faculty, if you will, that volunteers their time to again teach the next generation of competitors. So thank you there. Meredith has always done a fabulous job organizing the event, and we're super appreciative. Let me tell you about our judges, and we have some returning judges, some new judges, and I think our judges represent the full spectrum of old white guys who represent the old industry, if you will, and some younger, more diverse talent, which is, I think, a pretty interesting perspective. But let me start with Michael Lee from Lone Pine. Michael and I don't know each other well, but Lone Pine has really an outstanding reputation as one of the best firms in terms of the quality of their research. Firm that manages, Michael can probably give you a better introduction. You guys probably have 30 billion, some massive amount of capital under management, some long only, some hedge funds. Is that accurate?
That's right.
Okay, and they've done a really fantastic job. Jillian McIntyre. Jillian launched her firm a couple of years ago. Jillian, what would you say?
Yes, that's right.
She's a couple of years in. This is a business where it's really, really important in the first few years you do well. You have a bad first year, it's tough, and Jillian's off to a great start. Anna Nikolaevsky, if I pronounced her correctly, she has the great name of her firm. They built a whole episode called Billions after a firm called Axel Capital, but that's actually happens to be the name of Anna's firm. Anna is a long, short, very talented manager. John Paulson. John now in the family office business. John, super talented investor. I would say most famously known for one of the greatest investments of all time, his bet against the housing market circa 2008. Kat Sosnick, I guess CEO of a family office. I think Kat and I don't know each other. Kat, maybe tell us something about you, because I don't know you.
I'm actually one of the old ones.
Okay.
I'm the old guard. I'm not part of the new ones. I've been around since the mid 90s, and I actually worked with Lee, and my first job was at Tiger. So And I went to Columbia Business School, so I'm really excited to be doing this. And I'm sort of a distant cousin of your CFO, Ben. I'm from the same Persian community, so
Wow.
thank you.
Well, thank you so much for appearing tonight. Michael Sperling. Michael, can you raise your hand so we can see you? Michael works for Baupost Group. Baupost manages also about $30 billion. My relationship with Baupost goes way back. When I was at Harvard Business School in October of 1990, I opened my Fidelity brokerage account, and one of the first phone calls, I bought a book called Margin of Safety, which had just come out. And I called the author, who was a guy named Seth Klarman, and I said, Seth, I'm not looking for a job, but I'd love to come by and ask for advice. And by the way, I bought your book. And he said, you bought my book? So he granted me an hour of his time, and we became friends many years ago, and we've kept in touch. And Seth's built, one of the great firms, one of the really classic, great value investing firms. And Michael is, one of the, top people at Baupost. Two members of my team, Anthony Massaro raised his hand. Anthony's been at Pershing now for 6 years. How long?
July, I'll make 8 years, actually.
8 years. Yeah,
Time
can't
flies.
and Bharath, one of the younger members of the team, has been here, at Pershing for several years. And then lastly, let me just a little apology. I had my second shot vaccine yesterday, and the outcome for some of the people who have the shots is extremely high, high fever, a splitting headache, achy body, and exhaustion. And I have all of those symptoms as we speak. So I'm not 100% convinced I'm going to make it entirely through the evening, but I didn't want to miss. Actually, one of the benefits of virtual is if this were physical, there's no way I would have made it. But I'm going to do my best to make it, to hear all the pitches. And I may not make it to the end of the evening, but the group's in very good hands with 9 other very talented judges. With that, Meredith, let's go to the first pitch.
Great, thank you so much. First team, so we're going to start with Angie. First team, whenever you're ready, go ahead and share your screen. Okay.
Ready when you are, Bill.
Oh, we're ready for you. Go ahead.
All right, same thing. Just wanted to thank you, Bill, and the judges for being here at the Heilbronn Center for organizing, and the professors and all our mentors for their guidance this semester. I think I speak for all of us when I say we've enjoyed this. Without further ado, my name is Bill Henry, and I'm joined by Tom Moore and Dixon Powell. We're recommending Angie Inc., ticker ANGI, a home services marketplace company with a market cap of $8.5 billion, as a compelling long with a 5-year price target of approximately $45 per share, representing a 22% IRR. For many Americans, a home represents their largest investment, yet the process to maintain or improve this investment remains painful and outdated. The home services market represents one of the last large marketplaces that has yet to transition online. This is partially due to the older demographics of homeowners and service professionals, but also because scaling up a highly localized market with heterogeneous supply is difficult. As anyone who's needed work done on their home knows, finding a professional is painful, pricing often lacks transparency, and quality can lack accountability. We believe Angie is poised to solve these pain points and transform the home services market into a better outcome for all parties. The bears we spoke to expressed doubts around this, believing the company is nothing more than Google arbitrage, with limited ability to scale up its marketplace. However, we will show you why this line of thinking is quickly becoming stale. Moving to our key investment factors. While even skeptics acknowledge Angie's large underpenetrated TAM, we believe secular trends will accelerate online adoption. Second, the shift to a pre-priced model represents an inflection point in the business that will reduce friction for both customers and service professionals, alleviating some of Angie's supply issues, ultimately driving significant profitable growth through more transactions and better economics for Angie. Third, we believe that as the dominant player in the space, Angie has several structural advantages that position them best to succeed with management that has an unprecedented track record of building successful marketplaces. So a quick overview of Angie. Angie is a pure play home services platform whose 2 most recognizable brands, Angie's List and Home Advisor, merged in 2017. Angie's List ran a classified ads model, while Home Advisor traditionally ran a lead gen business model, where pros were charged per lead regardless of who does the job. In 2018, Angie acquired Handy, a leader in pre-price technology. So just to explain pre-price, since you'll hear it a lot tonight, in a pre-price job, a customer inputs the job details and desired time and the platform offers an Uber-style one-click price to the consumer, with the platform then in charge of sourcing supply for said job. HomeAdvisor has slowly scaled up pre-priced products across its platform, delivering 162 million in pre-priced revenue in 2020, and we see it as a primary growth driver moving forward to unlock the marketplace flywheel. Before we get into the value of pre-price, let's look at the addressable market. The home services market is broadly estimated at $500 billion. We believe Angie's near-term addressable market for this pre-price solution is closer to $300 billion when focusing on low and medium consideration jobs. The home services market has shown consistent growth, aided by trends including the aging US housing stock, while displaying less cyclicality than traditional housing construction spend. However, just beyond just the size of this market, what excites us the most is the home services market remains largely offline and highly fragmented, with more than 80% of home services still done through these legacy channels. Angie, as the largest online player, has a natural supply and liquidity advantage over competitors in a market that is begging to be disrupted, as millennials now represent the largest segment of home buyers. As evidenced by the fact that millennials will buy cars or even houses online, sight unseen, millennials will require a one-click on-demand solution for home services, which positions Angie to gain GMV market share.
We're not sure how much time this distinguished panel of judges spends coordinating and scheduling home services work these days, but as a customer, it's a pain. You need to find reputable professional, speak to multiple providers over the phone to get soft quotes, and then you're very likely to have to renegotiate on site when the service professional looks to upsell. Pre-priced transactions executed on a platform are a natural market evolution as it shifts online. Reducing the sources of friction you see here results in a much faster, more transparent experience for both customers and professionals alike. The primary complaint that we heard from service professionals about the lead generation model was that after paying for the lead, there was no guarantee that the lead would convert into actual business. That uncertainty forces Angie to undercharge relative to other marketplaces despite its size. Conversely, we estimated that in 2020, Angie charged about a 31% take rate for its pre-priced services, and we projected the business mix will shift towards pre-priced over the life of the investment. So why do we think that pros will prefer pre-priced? We repeatedly heard from pros that they want to spend less time tracking down work, negotiating, and following up on payments, instead focus on getting the job done, which is exactly what the pre-price model provides. Our primary research indicates that pros want and like the service, primarily because pre-priced jobs allow pros to replace that non-revenue time with more jobs, driving higher overall sales to the pro. Cutting the amount of slack time in a service provider schedule in half results in about a 15% more revenue per available working hour. Additionally, there's a psychological shift for the pros as Angie moves from an advertising cost center to a revenue center. And when we spoke with Angie's CEO, he told us that it's been much easier to bring service providers onto the platform when you're offering them a job in hand as opposed to selling them a lead. From a customer perspective, millennials are less handy, reported a lower level of confidence in recognizing a fair price. We're willing to pay a premium for a no negotiation service. Pre-priced jobs drive the user to the app through features like tracking your pro's location on the way to the job. And app users are significantly more likely to be repeat customers, reducing CAC and improving LTV. App usage jumped 50% in 2020, and based on a 15% CAGR in app usage assumption, we project advertising expense per service request to fall 30% by 2026. So with pre-priced, Angie and its shareholders benefit from a higher take rate and should see reinforcing benefits from direct pricing and customer data. You can see the impact on an actual low-price job that our team purchased through the legacy lead generation model. Based on our survey data, we assume customers would pay 10% more for convenience and Angie's quality guarantee, and pros would take 5% less for the guaranteed job, resulting in significantly better economics for Angie. Low-price jobs skew towards much higher take rates, but the model is financially advantaged across jobs of all sizes. So finally, moving to pre-price improves Angie's competitive positioning. Advertising expense was 30% of Angie's 2020 revenues, and transactional marketplaces tend to spend far less per click. While Angie's percentage of search traffic from paid sources has been falling, it still has a huge opportunity to bring down per job ad spend. The move to pre-price also expands Angie's moat over big tech competitors. Executing and guaranteeing transactions requires employees that can moderate scope disputes between customers and pros, something that Google and Facebook aren't interested in doing. Finally, of its direct peers, only Angie has the service provider scale required to offer fixed pricing, and upstarts lack the cash to get there.
Despite the obvious value proposition, pre-price is still not the norm due to two significant hurdles. One, given the numerous types of services and its local nature, to operate this business at scale, you'll need to solve hundreds of thousands of micro markets. Worse still, these are highly complex transactions. The result is that pricing correctly at scale has been a big challenge. But we believe Angie will be the player to succeed because of three unique and compounding advantages. First, as mentioned, it has significant relative scale. allowing to spend more on acquiring customers and service providers at a lower unit cost. Second, it increasingly has a data advantage due to its long operating history and the large number of transactions it helps enable. Third, it continues to face excess demand and generates free cash flow in excess of earnings. And we believe Angie has the best management team. Angie is 84% owned by IAC, which has successfully scaled a number of marketplaces by tapping into nascent markets, consolidating through acquisitions, and continuously tinkering with product and management teams before investing aggressively in growth. And we see a similar path forward for Angie, especially after Handy co-founder Oshin recently took over as CEO. Our call with Joy Levine confirms that IAC wants to reinvigorate the Angie level as the company pushes forward the pre-price model by giving the rein to a young and energetic leader. As the new management team ramps up efforts in implementing pre-price, we conservatively forecast Angie can convert around 24% of the low-price job volume into the pre-price model by 2026. And we believe the sell side is missing it. Due to the difference in revenue recognition, the gross margin of pre-price transactions are much lower. And if you look into the barely declining gross margin projections, we can infer that they are not forecasting any meaningful changes in the business mix of Angie in the next 2 years. And once the flywheel comes into motion, we see a clear potential path for a 10-bagger in the next decade. If Angie executes on the strategy of pre-price, it will eventually become the transaction engine for one of the biggest verticals in this economy. Customers will love the platform and manage their home service needs through Angie, and suppliers will have to rely on it. With very reasonable assumptions of market growth, market share, and tick rate, Angie could generate $3 billion plus in EBITDA. And for it to become a 10-bagger, you don't need a heroic multiple. Now to our base case valuation, we're expecting a 20% IRR. This is mainly the result of strong gross profit growth and margin expansion. We're only assuming pre-price penetration increasing from 1% to 7% of GMV by 2026. And we're conservative with our exit multiple. Effectively, we're assuming we cut by half. Among the value drivers here, I want to focus on the marketplace take rate. At face value, they do not seem to differ much in each case, but the impact of earnings is significant since margin are now less than 1% of GMV. Looking into two other cases, in the bear case, we assume slower pre-price penetration and margin expansion, meaning due to the higher CAC. And for the bull case, we assume the subscription model will increase transaction frequency. We also perform an inverse DCF to understand the implied market assumptions, which we believe can be easily exceeded. Finally, we believe the probability distribution skewed to the right, and the resulting probability weighted price is $40 to $5 per share. We identified several key risks in our investment thesis, and we're happy to address them in the Q&A. Thank you.
Okay, well, wow, that was a lot of information in a relatively short period of time. So why don't I turn it over to our judges who would like to ask the first question? Jillian, go ahead.
First, yeah, sure. I thought it was a great presentation, and I liked the detail that you gave on the primary research list that you went through. I guess what I'd like to understand a little bit more about the background of the CEO. Obviously, we put a lot of emphasis on the management that's running the company. And, you know, my sense was that Handy was not a profitable company when it was taken over, and he had been quite heavily diluted before the acquisition. So what gives you confidence that, you know, someone can go from running sort of a, 350, I think, $400 million company to, taking over an 8 billion company, and the pay packet looks quite lucrative.
Sure, I'll try to take that question first. Thank you for the question, Julian. Mainly our confidence comes into the fact that in the previous 3 years, Angie has a couple of CEOs in changing in the past few years. And both of those people actually, as you can see here, they came relatively early into the company in 2011. They are really considered the architect of the lead generation model. And so when the business transition to this pre-price model, they're not seen to be fully engaged with this new model. And what really excited us about Oshin is that he lives and breathes this business model. This is the reason why he dropped out of Harvard Business School to start this business. And while it's true that Handy had was not able to scale massively on its own, they are the survivor of that space. Back then, when he first founded Handy, there are a lot of VC money going into startups that try to be Uber of something, the gig economy that they say. And as they transition out of that space, to survive, he was really able to navigate the whole changing economy and business cycle. And we think that his flexibility and vision about where he wants to take this business really excite us. We had a chat with Oshin, a 30-minute chat. We asked him about his vision And we're just really impressed by how he see what's the company should go in the next few years and what's the step needed to take us there.
Actually, let me just jump in for a second. Maybe this is an indication of my vaccine recovery. I forgot to introduce Mary Gabelli. And so there's Mary Gabelli. People say this person needs no introduction, so I just assumed he needed no introduction. So I didn't mention that he's one of the judges, but apologies. But Mario, do you have a question?
And I actually just kind of going to the end zone as opposed to the details of getting there. Barry Diller has spun off a lot of companies in the past. He's been very good at digital. He's just gone into the gaming business. They've announced that they're spinning off Angie's List. Did I miss something in this process?
They have not. So they're spinning off Vimeo in Q2 of this year.
Yeah, that's
yeah.
So, but he builds them up and then spins them off. Is that Tom? Is that a fair assumption?
Yes,
I would say so. Yep. Yeah, I
Thank you.
think that's fair. That's what we've seen most recently with Match. Sure.
Could I jump in?
Please.
All right. Great presentation. I actually spent quite a while on your more extensive presentation, so I have 3 quick questions for you. So the first one has to do with the gig economy. I mean, we as a fund are very bullish on the gig economy. Fiverr was one of our top holdings last year. And what we loved about Fiverr, what appealed to us was that how they triggered users to buy gigs that they had no intention of purchasing. So say I went on to Fiverr, I wanted to buy a family photo book. Suddenly I was buying a family video montage. So suddenly I was buying family art. So they were really good at cross-selling and upselling their product. And I'm wondering, I haven't used Angie. I live in an apartment in the city. I don't have a house. So I actually don't have the need for a product like this. But if the algorithm for Angie actually on any of their platforms, because I know they have different brands. So say you want to buy, you buy a paint job, will you then be shown a window treatment? Would you then be shown a bathroom remodel? So that leads to the huge potential to increase your transaction per customer. That's my first question. My second one is, I saw you did a lot of high level primary research, which is great. But as far as the grassroots pedestrian level research, have you spoken to contractors? What do they think of the platform? Especially like, what is their preference to using the platform to just going through Google Ads and Yelp and getting access to customers there? And then my final question is, have you done random searches like electrician near me or plumber near me and seen if Angie's List or any of their other brands show up in the top 3 of the search results, because I think that Google is pretty powerful in this space, and they're really competing against Google's ads for this area, this space especially. So, just 3 quick questions for you.
Dixon, do you want to take the first with the purchase frequency?
Sure. So right now, what we know is that homeowners should have remodel or fix or maintain their home around 6 to 7 times a year. But because of the highly friction process this current Angie now has, customers only do that 1.8 times per year. So there's a lot of room to really increase the purchase frequency as the friction is being reduced. In our model, we're really conservative. We only assume that it will eventually, because of the pre-price model, only increase the purchase frequency by 2 times. And with that, the economics for Angie will improve a lot already.
Yep, and I can take the second piece as far as boots on the ground research. We talked to about 15 service providers directly, and we got some really interesting quotes, like first around the lead generation legacy model, leaving a lot to be desired. It's just tough for them to invest a lot in leads when they're not sure it's going to turn into actual jobs. And so that's where an alternative like Google really comes into play. And then second, as some in an industry where it's really about filling up your schedule, it's really powerful to have an option where when somebody cancels last minute, which happens on about 19% of jobs based on our survey, you have an option to fill that slot. And we really think that brings a lot of value to the supplier and it can help with liquidity issues. So may not have gotten to all of it, but that's what we would say there.
I can hit the last question too. In terms of like where they show up, yeah, Home Advisor or Angie is usually one of the first 2 or 3 at the top of the list. And that's why people have historically called them a Google arbitrage plays, because they compile search and then go to the top of the funnel. But I think what we are super excited about this opportunity is once you kind of move it off app and kind of develop this habit, then you kind of disintermediate Google. And Google's not going to be in the business of being able to source supply. They're consistently just want to be a lead gen business. And here, Angie is, facing both the consumer and the supplier, and Google just doesn't have the resources. And we don't believe that they want to invest to be able to have this network of service professionals that they're calling and sourcing all the time.
John Paulson had a question.
Yeah, thank you. My main concern with this investment is currently looking at your preset, they only make about 100 million of EBITDA and have an $8.5 billion valuation. So they're trading at 85 times EBITDA. And then, the earnings go up somewhat next year, but it's still 46 times EBITDA. So the issue is, I think is they're very complex, very hard organizing this, making fees, getting people, hiring the right people, getting them delivered correctly. And as a result, margins are beginning. And the problem is if you don't fix the margins, improve the margins, then, the stock would be over today. Never mind, increase 6% over the next 4 years. But
Yeah, so actually, to add to John's question, help us, how do you think about valuation? How did you decide what the right price, what this business is worth? What's their methodology?
Yeah. So we used a combination of EBITDA, price earnings, and then a DCF in order to get to our exit multiple assumptions. Just to hit the first part of John's question, it was really 2020 was a particularly tough year for Angie because when you make money by selling leads, you need a lot of demand needed for the supplier. So when they can't work for a month and then everybody needs work, they're more inclined to turn off the leads. And so that really took a hit on the revenue as well as the margins. But early returns as far as March have been really positive from that perspective. And we think that with pre-price as well as the rebound in the lead generation business, it should be back to where the base case was. And then, yeah, in terms of the valuation, our exit multiples were really in line with where it's traded historically. And we took a very significant cut the way that Dixon mentioned in terms of where we think it'll be trading in a few years.
Mm-hmm. Yeah, I would just, this is kind of a turnaround business. And it's not only a turnaround, it's question, does the model work? Can it produce, enhanced margins? And if it doesn't, it's not really a question what the multiple is, can the earnings go from 92 million to 836 EBITDA here? If that's happening, and it really doesn't matter what the ultimate stock.
So I'm gonna pause us there because we're out of time, but that was a great presentation. And thank you. Okay, who's next?
Great. Team 2, whenever you're ready. Avalera.
Go for it, Team 2.
Perfect. Can you see our screen okay?
Yes.
Awesome. Well, good evening, everyone. To Bill and the judges, we wanted to thank you all very much for this opportunity. We do greatly appreciate this. We're recommending a long on Avalera with a price target of $850. This implies a 6 times return on your money, roughly 20% IRR, and a base case that exits at 2030. So quick overview on Avalera. They're a leader in tax compliance software, helping customers calculate, file, and remit transactional taxes. Market cap about 13 billion, doing about 500 million in revenue, historically growing top line at about a 30% CAGR. Before we focus on Avalera, we want to take a step back and provide context on Avalera's market. Prior to 2018, if you ran, say, an e-commerce business, you paid a single sales tax rate that corresponded with the jurisdiction of your physical presence. So here's the first key point. In 2018, the Supreme Court ruled that e-commerce providers must pay taxes in accordance with the jurisdictions that they sell into. This led to a paradigm shift and a new mega trend of outrageous complexity. There are over 13,000 US sales tax jurisdictions, and rules for these jurisdictions are always changing, to the tune of 300,000 updates per year. To make things more complex, taxes differ by product, and there are over 16 million unique product codes. So now for the second key point. The average small mid-sized business uses between 2 and 4 application systems that can be ERPs, e-commerce providers, billing systems, and so on. For customers to calculate sales taxes, they need to aggregate data from all these multiple application systems. This is done manually in a sluggish process that consumes hundreds of hours. Primary research indicates this is, quote, almost impossible to be compliant. So another important point here is, given this complexity, we believe all of the sales tax market needs to be automated. So we want to pull this together and provide you with an example. If you're a mid-sized business selling, say, t-shirts, you may be required to pay different tax if you sell the product into a new city on one side of the street versus the other, or if you change the fabric of your t-shirt. You then have to manually aggregate data from all the application systems you're using. And you're likely non-compliant. So our third key point here is that sales tax enforcement is to increase dramatically given budget shortfalls, serving as a near-term catalyst. So given that industry backdrop, the story here is Avalara sought to automate and monopolize the sales tax market. First, it aggregated tax content for over 13,000 jurisdictions. Second, it realized you can control the market by controlling the relationships with the application systems themselves. So to establish control, Avalara built bridges or connectors to applications that automatically aggregate that data. These connectors cannot be easily replicated, giving Avalara de facto exclusivity. Avalara then created a cloud-based software offering that integrates with the customer to automatically calculate, file, and remit transactional taxes. And by disrupting this manual space, Avalara asserted itself as the ADP of tax, a company Pershing Square made over $1 billion on for its investors. So judging our variant view, we think the market's underappreciating Avalara's moat, growth opportunities, and the importance of its partnerships. And it's overweighing the threat of new entrants. Our key investment factors are really 3 points. First, the economic moat in the way of network effects, scale, customer captivity. Second, attractive $22 billion SAM with significant white space and secular tailwinds. And third, meaningful growth avenues. Dominance in the mid-market will serve as a launchpad to financial expansion into enterprise and international segments. So with that, I'll pass it over to Rich to discuss the moat in more detail.
Thanks, Dave. So our first key investment factor revolves around Avalara's moat that we believe is supported by 3 competitive advantages. First, network effects. Avalara's customer base of over 14,000 attracts applications that make connectors for Avalara's platform, and Avalara's 1,000 application relationships attract customers that need these connectors. This network would be exceptionally costly to replicate. Second is scale. For a competitor to disrupt Avalara, it would have to aggregate tax detail for over 13,000 US jurisdictions, staff a team to implement 300,000 annual tax changes, replicate Avalara's connectors, and build software programs that can calculate tax at the rooftop level. Our third point is there are 2 layers of customer captivity in the way of switching and search costs to both the customer and application provider. We built an ROI analysis that suggests a customer will realize a 4.5 to 1 return on their investment with conservative assumptions and only need to save 26 minutes a week to break even. Our second key investment factor is that adoption of automated solutions must occur, and this has been catalyzed by legislative and COVID-related dynamics. On the legislative side, a major catalyst domestically that changed the game entirely was a Supreme Court ruling South Dakota versus Wayfair. This occurred in 2018, and since 43 out of 45 states with sales taxes have passed laws allowing states to collect tax from remote sellers. Internationally, many countries have recently adopted common value-added tax laws or adopted e-invoice mandates that require real-time reporting and remittance. Now to touch upon the COVID-related industry tailwinds, COVID catalyzed first e-commerce growth, a key market for Avalara, and second, adoption of cloud-based ERP systems, a key opportunity for executives to transition to Avalara. The final driver here is that a step up in enforcement will lead to a meaningful increase in adoption. For context, sales tax is the largest source of state and local funding outside federal receipts. US state budget shortfalls are estimated to be around $400 billion through 2022. This will drive local tax authorities to prioritize collection to plug these deficits. To give one supporting point, the IRS and other tax collection authorities announced they will increase business audits by 50%, which will expose non-compliance, driving adoption. When we think about sizing the domestic market opportunity, we created a bottoms-up build informed by our primary research conversations that suggests a market opportunity of around $14 billion currently, reaching $27 billion by 2030. Quickly touching on the international opportunity, we focused on the EU and Brazil because that is where Avalara has been the most acquisitive and built out its content base. We estimate the SAM to be about $4 billion, growing to $7 billion by 2030. When we analyze the competitive landscape, it is clear that Avalara made the right decision to go after the mid-market segment first, and only in 2020 has Avalara begun the journey of entering the enterprise segment. In the mid-market, Avalara is competing against manual, homemade processes that make up around 70% of current solutions that are very inaccurate and far more expensive. These customers must automate, and Avalara is the only viable solution since it is the only provider of connectors covering all applications. Avalara spent 10 years building 1,000 connectors, and enterprise players have less than 1/10 as many. Tax automation does not work unless you have connectors for all point-of-sale applications. Historically, legacy enterprise providers created bespoke offerings that require manual updates that are incredibly costly, requiring offsetting price increases, whereas Avalara's cloud offering efficiently pushes updates to all customers. And with that, I'd like to pass it off to Frank.
Thanks, Rich. So we really think that given where Avalara sits, it's got myriad avenues for growth in all three segments of that market. But you can see what we're really betting on here is that Avalara is going to continue doing what they've already been doing, which is dominating that mid-market. So you can see on this bridge in that blue box, their mid-market sort of bread and butter, call it 20 to 500 employee target companies is where most of the growth we're projecting in our model is going to come from. And we think they can expand penetration from single digits today to around 40% by 2030. Then when it comes to valuation, stock's currently trading at 19 times revenue. And I'd point you to that lower right-hand side of the page. You can see that compared to its SaaS peers, it's a cheap business on a growth adjusted revenue multiple basis, especially given how long the runway of this business is. So it's got all the pieces to be a long-term compounder, and we think Avalara can be a multi-bagger over 10 years. You can see roughly equal parts of the return are driven by revenue growth and operating leverage. It's currently break even in profitability, but we think in the long run, they can do 40% margins. And so we ran a 20-year DCF, and we're exiting off an EBITDA multiple of 14 times, which is a 5.6 times revenue multiple. So to put that in context, that represents 13 turns of multiple contraction relative to the 19 times it's trading at today. And so that gets you to a 15% IRR before capital allocation. Company's going to be a cash flow generating machine, and that cash has got to go somewhere. So we think that you can really get to a 20% return with M&A and share repurchases. So that's a lot of numbers, but to back up and think about the simple math, let's recap. So qualitatively, as Rich mentioned, sales taxes are becoming more complex, more enforced, and so they'll have to be automated. There's a step function change not only in complexity, but also a step function change in enforcement. And so nearly every SMB will eventually adopt a unified and automated tax solution. It's really a matter of when, not if. And we really think that Avalara is positioned to win it all because they've got this de facto exclusivity on integrations, which is a powerful moat. And they'll continue to just dominate that mid-market. So as a result, we think they can increase penetration of their overall SAM to 30% in 2030 in this huge growing market that's going to double in 10 years. And then the company is going to grow EBITDA and EPS as it scales since it'll achieve operating leverage. And it'll go from break-even profitability to 33% margins by 2030. And we think 40% in the long run. And so overall, we think this can be a 20% IRR over a 10-year hold with a low chance of permanent capital impairment. It's a sticky SaaS company providing a service that every SMB is going to need, and it dominates that space. So that's really the viewpoint we've come to through our primary research calls. So thanks for listening, and we'd love to answer your questions.
Okay, who's first? Yes, Jillian.
So great presentation. Totally get the moat, but with respect to the financials, can you talk to the change in the treatment of their cash? I believe that there was a restatement for 2019, 2018, and they also had a material weakness in their internal controls. So is that an issue that's been resolved, and why doesn't it matter? Thanks.
Yeah, maybe we can go to the slide about the management team change. There's they have a new CFO, and we think that their new CFO is able to have the proper internal controls. And with regards to the accounting, we don't think it's material. It didn't come up in any of our primary research.
Yeah, happy to touch on management here. So as Frank said, he did hit the nail on the head in terms of the management change. So CFO is really a new manager here. We provide context on all the management really, but when we thought about understanding the management team, we wanted to look at their backgrounds, obviously, make sure they were sound. But we also wanted to speak to references. So we spoke to half a dozen people who either worked directly with the managers or knew them personally, were long-term investors who have had extensive conversations with them. So, you brought up a great point on financial controls and making sure those are sound. So we spoke to half a dozen investors that knew Ross Tannenbaum personally, who's the new CFO. He joined about 2 years ago. Banker from Goldman, covered software. People say he's a, quote, solid guy and high integrity, quote, hard worker, quote, understands the business. We think he's, meaningful investor in the company, has about 10 million in stock. So, the feedback we've received on him has been positive. We know that the former CFO was sort of more viewed as more of like a visionary in some instances. And we did hear positive things about him as a person, as a participant in the business, and he still sits on the board. But he was less the sort of like in the numbers type guy, and so he decided to step away to really golf, still stay involved with the company. But this new CFO is very much hands-on and focused on these things.
I think Michael might have had a question. Michael Lee.
Yeah, I was curious. How does Avalara work with major marketplaces, and how do marketplaces calculate taxes? And I'd be curious, is that a risk, partnership opportunity, or I'd be curious kind of how you guys think about that.
Yeah, so Avalara connects right into all the major marketplaces. So whether you're Amazon, whether you're Shopify, they're sort of a company that everyone's as a buyer has used before and may not even realize, because they're often sort of white labeled underneath that marketplace. So it sort of plugs into that marketplace and then basically sends that tax data to the actual customer to flow through to their other respective payment systems and ERPs.
Yeah, so we did watch onboarding videos showing YouTube how people kind of go on and input information, and did a couple of product demos, and people just sort of like you input your specific codes relating to the e-commerce systems you're using, and then the connectors are in place, automatically seamlessly integrates, and then Avalara takes it from there.
So I really, maybe we're going to sound a little like John Paulson from the last panel, but you said that basically low risk of a permanent impairment of capital. When you buy something at whatever 19 times revenues, and the value of anything is the present value of the cash it generates over its life, right? So you have to get to a place where this thing eventually is going to generate a sustainable amount of cash flow in order to justify its life. And the fact that we're pretty far away from that point, I do think creates risk. I mean, there are very few examples of monopolies in the world. The world is companies don't like monopolists, if you will, and so it's rare for that to take place. So I think the essential, if I understand your thesis, part of your story is that these as you call them, connectors or integrations are what give them, if no one else can replicate what they replicated. It took 10 years for them to do it, but the world's changed a lot in the last 10 years. And so, and there's been consolidation, in marketplaces, for example, and winners is, a lot of these connections probably don't matter as much as the world, consolidates the leaders, et cetera. So help us really understand how durable that competitive advantage is and why it's impossible for someone else to disrupt them.
So I would love to start there. So first of all, just compared to the existing other providers in the market, Avalara is the only true SaaS solution. So Vertex and Thomson Reuters are longtime legacy providers that provide sort of on-premise solutions. And whenever a tax change happens, which happens all the time, they often have to update that at every single individual place, where Avalara can sort of push that out to everyone. So aside from the point that you made on the connectors themselves, we view this as it's something that everyone is going to need, and Avalara is the perfect partner for them because we view them as Switzerland. So let's say like someone else, like a payments or an e-commerce or an ERP platform wants to move into this market. The key is owning all the connectors.
Just pushing back on that for a second. I mean, for example, Stripe, right? Stripe is a middle market payment system. They're constantly developing new apps that deal with jurisdictional issues, et cetera. They're very well capitalized. I think they've got meaningfully greater revenues than this company. how do you think about that, business as why can't they, there's certainly a SaaS company, why can't they sort of instantly become a better competitor here?
So it's sort of like the database effect. I mean, there's tax content. I know it's kind of weird to think about, but acquiring that tax content takes an insane amount of time. And that it's all the product codes. It's 300,000 annual updates to do this. The experts we've talked to is this needs to be a core competency, just due to the changing nature of the tax codes and the tax products everywhere.
Okay. Other questions?
Yeah, well, so I guess I think it's a great question, Bill, and just to give you a little more information on that, because it is absolutely critical. So, the point on the integrators themselves, we did speak to in our primary research, we spoke extensively to a handful of different executives. One of which was with the former executive of Vertex, who's the largest competitor in the enterprise space. And we wanted to get a sense of how durable the connector's advantage actually is. So we asked if they're important. She said, absolutely, they're important. And we asked if Vertex could replicate those. And her quote was, it would take a lot of time and effort to replicate Avalara's integrators. There's an area where Vertex could spend 100% of their time and never get caught up. And then we asked, would they ever want a coming down market? They said Vertex tried several years ago to come down market.
I think it's hard for kind of the legacy players to compete. Let's concede that. But there are a lot of other emerging companies in payments where this seems to be a logical place for them to be offering services. And they're, this company, again, is not, I don't know, I haven't looked at the balance sheet, but is it, what's their balance sheet look like? How well capitalized are they? What ability do they have to invest, et cetera? And what is your risk?
Yeah.
A payments company doesn't just offer this as an ancillary service, on top of their existing platform.
Yeah, I think the point's really the one that Rich hit on. Having coverage of 13,000 U.S. jurisdictions, you really have to have the calculation done at the rooftop level. If you cross a street, you can have a different tax rate than the other side of the street. There's many different sub-tax codes within cities and states. So you have to calculate it all out. It's always constantly changing. So you have to build on-person staff to constantly run the recalculations to the tune of 300,000 a year. And that's a very challenging process. We spoke to a sales tax executive who runs sales tax advisory, and that's sort of about content acquisition and accumulation, which is extraordinarily challenging to do. It's sort of like a mining process. So overall, very challenging. In terms of balance sheet, no debt. It's just huge cash balance. So very well invested and definitely long-term vision with strong owner operator.
Okay, Meredith, how much time do we have?
Hold on 1 second, Bill. We have 1 minute left.
Okay, last question. Who would like to ask the last question? Mario, or actually Michael hasn't asked a question. Go ahead, Michael.
Yeah, I'll just ask a follow-up to my prior question. I guess the challenge that I've always had.
Actually, Michael, apologize for doing that. Michael Sperling, apologies. And then Mario.
Thank you. You guys mentioned that the vast majority of growth is coming from the mid-market. Can you just talk about how you thought that 40% penetration is the right number? Why not 20? Why not 60? What work you did to arrive at that?
Yeah, so we think that technology tends to follow this sort of S curve of adoption. It sort of accelerates over time, and then it sort of flattens out. We thought that 40% even seems conservative, because if you really believe that the market doesn't understand the narrative that this company is a near monopoly in a market where they're selling something that every SMB is going to need going forward due to that step function change in complexity and enforcement. And then you'd have to believe that they're going to win it all because of the strength of their moat. And so we think that 30-40% SAM penetration almost seems conservative. And so, because it's really a matter of when and not if.
Okay, Mario, do you have a quick question? You're on mute, Mario. Can't hear you. You're on mute. I guess he doesn't have a question.
Hey, great.
Thank you.
Okay, thanks very much. Great presentation. On to the next.
Team 3, black line.
Go for it, guys.
Song, you got the slides up? Yep.
Can you see it?
Yep.
Yep, perfect. Do you mind flipping your camera on?
Oh, sorry. Yeah. Yeah,
Great.
Can you see my screen? And
yep.
Okay, cool. All right. So thank you, everyone. Tonight, we're excited to pitch a Blackline as a buy with 5-year price target of 322 reflecting a 3x return and 24% IR. We identify multiple sources of competitive advantage, which position the business to deliver superior return, namely a best of breed product with a strong value proposition, strong unit economics, and operating leverage. Continue capturing a large and expanding market with multiple catalysts. Blackline is a leading cloud-based SaaS provider of automation solutions for financial close and account receivable management. The company serves more than 3,400 clients globally, including 50% of Fortune 500, and generates over 105% net revenue retention. As seen on the bottom left, Blackline has tripled revenue over the last 5 years, growing at a CAGR of 30%. This increase was driven by 18% growth in the number of customers and 11% growth in the average revenue per user. Our first thesis point is discuss Blackline's best of breed product and strong competitive positioning. To illustrate the product, we compare two stylised close process with and without Blackline. At the bottom, we have what normally happens during legacy financial close. It's a manual process with many steps, could take as many as 15 days. On the top, we show how Blackline software automate the entire process using rule-based algorithm to match transaction and generate transparent reports. This creates huge time and labor saving, reduce risk of manual error, and building trust in the process. Human input is only limited to reviewing exception, freeing up resources for more cognitive work. As a result, implementing Blackline creates significant value for customer. With the software deeply embedded in the customer workflow, it becomes difficult to switch. Despite Blackline's already premium pricing, our research indicates that customers are willing to endure even 50% further price increase. Historically, Blackline has increased price 6 to 8% for renewing customer with limited pushback. In addition, users strongly prefer Blackline's intuitive and consistent interface, especially compared to alternative vendor. The platform helped to drastically reduce closing time, labor resource, and even material cost. On average, Blackline generates $2.77 for every dollar invested. Despite the cost saving, some executives we talk have a different way of calculating ROI. By reducing manual input, Blackline helped build confidence in the process, allowing financial leaders to sleep better at night. Primary research show Blackline leads in its peer group by size, customer feedback, and favorable market positioning. The company's strong product is reflected in premium pricing, as well as ability to capture more than half of the tap market, double the size of the biggest competitor. There's some natural segmentation among competitors. For example, TrimTech is preferred for high volume transactions such as e-commerce. OneStream is primarily focused on a Hyperion user, and Flowcast is targeting a low end of the mid-market with a basic budget solution. The company's leading position is recognized by top industry publications, and our search engine analysis on the bottom reinforce a review of the strengths of Blackline's brand. On the right, we show how Blackline's obsession with customer success, product excellence, and innovation continues to deepen the competitive moat around the business. Here, I transfer to Diksha.
Our second thesis point focuses on how these considerations translate into strong unit economics and improving margins for the business. We consider switching and search costs relative to similar software. While it's certainly easier for a client to rip out Blackline than an ERP system, the question really becomes, what are they going to replace it with? Absent compelling alternatives, customers stick with Blackline. This supports not only high retention, but annual pricing increases, which drive CLV. High value proposition and brand leadership help Blackline manage its customer acquisition costs. The recent increase in acquisition costs reflects an expansion in the APAC region, which required substantial investment over the last 3 years, but is now coming to fruition as the company gains traction. On the right, you can see how these factors translate into margin improvement for the business, a trend we expect to continue.
Thank you, Diksha. That brings us to our third thesis point, which is a $28.5 billion market opportunity, of which we estimate less than $1 billion is tapped today. Among the existing players, Blackline is more than 2 times the size of the next largest player, reflecting the strength of its product and competitive positioning. Now, Song mentioned that among competitors, there's some segmentation. But before we even get to that, we want to highlight the size of the total pie. Given the large opportunity, we see limited risk of encroachment, allowing Blackline to compound its momentum. We identified multiple channels for the company to unlock this market, with international growth being one of the key factors. APAC in particular represents a $9 billion opportunity, which helps explain why Blackline has been investing heavily in the region. Now, this underscores our view on the growth runway. Based on our research and expert calls, international and mid-market segments represent a significant opportunity for sustained long-term revenue growth. So how do investors bridge the current 1 billion market with a 28.5 billion opportunity? Based on our research, both secular trends and consumer sentiment point to an accelerating rate of adoption. As it stands, the true promise and potential of digital transformation, which is reallocating human capital towards cognitive high-value activities, remains elusive. Finance professionals feel their systems are lacking and would like to automate a lot of the manual, low-value work in the close process. Strides towards distributed workforces and business process automation are permeating C-suite discussions. COVID-19 emphasized gaps in the financial functions across businesses, adding further attention to the need for digitization in the back office. Over time, automation will become the new frontier for competitive differentiation, and a platform like Blackline will evolve from a nice-to-have to a must-have. Now we highlight Blackline's acquisition of Remilia, an AR automation platform, for two reasons. First, Remilia has strong brand awareness in Europe, which should help Blackline to continue to establish itself in the region. The tool is sold into the same function at a client, making it a natural product extension. And second, Blackline paid approximately 150 million for an industry leader to access a $10 billion market opportunity. We think this reflects favorably on management's capital allocation thinking for the long-term growth.
The Blackline leadership comprises of accounting software and technology veterans who have a history of driving growth at successful software companies. The executive chair and founder has over 45 years of tech experience and led the company shift to a 100% cloud business model in 2008. The CEO, Mark Huffman, during his previous 14-year tenure as CEO of NetSuite, grew it from a $3 million to $1 billion enterprise. Huffman and the Blackline leadership are geared for growth, with a 50% growth in customer base since 2018 under Huffman's leadership, and a 44% increase in organic R&D capacity, which is double that of the next big one. The biggest risks that Blackline faces are if the pace of back office modernization ends up being slower than expected, if the competitive landscape changes as profitable industry tailwinds attract new entrants or intensify existing competition, and the risk from customer concentration. However, we are confident about Blackline's competitive position because it is a best-of-breed product built on 2 decades of proprietary learning, something that can't be replicated by an upstart. Its deep focus on customer retention is evidenced by a 97% renewal rate and its COVID relief program, under which Blackline provided free modules and coaching to its customers. Further, industry as well as our own primary research has showed that COVID increased the urgency to invest in automation. And Blackline, with its mission-critical product, is in a unique position to prepare organizations for the future of workplace post-pandemic. Blackline had a solid finish to 2020, beating street estimates with strong indications of further recovery.
So to sum that up, over the last 9 minutes or so, we hope to convince you of 3 things. There's a large market opportunity. There are multiple tailwinds working together to expand adoption, and Blackline is the single best company to capture this trend. Now, there are multiple ways for Blackline to continue expanding, and our research indicates that the growth engine is firing on all cylinders. Our thesis support a favorable case, which allows for modest multiple contraction, but assumes that sustained growth will support a healthy valuation. This brings us to a 3x return or a 24% IRR over 5 years. Our customer growth is in line with historical figures, and our pricing assumptions reflect a rising share of mid-market clients, which typically have a smaller spend. Our return composition is driven primarily by customer acquisitions, again, reflecting our thesis on the expanding adoption. And with that, we want to thank you for your time, and we're happy to take any questions.
Okay, who's first? Anna, did you have a question?
Yeah, I have a question. So I'm looking at consensus numbers, and for 2021, it looks like that both EBIT and EBITDA are down pretty substantially. Why is that? And then why does everything bounce back next year?
So management has noted that 2020 compared to 2021 was the margins were inflated because they kind of cut back on travel and a lot of kind of the travel, entertainment, sales, marketing expenses, with that being virtual. They do anticipate, and they've guided significantly over the conference calls, that that spend will increase over the next 12 months.
Okay, how big is that spend? Did they quantify it?
They have not, no.
Thanks.
Mario, did you have a question?
No, I was just checking on a number. Thank you.
Okay, can you help us on valuation? And I find what's interesting here is you got a 20-year-old company. Take us through the income statement. Yeah, help us think about value.
Yeah, absolutely. So you're absolutely right. This company has 2 decades of operating experience. I guess I should stick in that we do view this as a moat, or as contributing to the moat from the learnings that it has generated working with over 3,000 client organizations. Thinking about valuation, we certainly use kind of a shorthand multiple here, but we do also look at what the DCF implies. And Song, if you would be kind enough to flip to that page. Now we do this for illustrative purposes. What you see is that the longer you forecast out, the more room you have for multiple compression and still getting to an attractive price target today. Funny enough, you can actually see which sell-side analysts kind of forecast to 5 years and which ones go further out. If you look at profitability, we actually think our exit EV to EBIT multiples are in line with where more mature software businesses are trading today.
Okay, so if I take your page here, what I think is interesting, so for example, look at terminal multiple method, right? You have basically all of the value of the company, 9.2 billion of the $9.6 billion equity value comes from the terminal value. How do you think about that in terms of the risk of being an investor in this company?
Yeah, absolutely. I guess.
And lastly, you've got a business been around for 20 years. It's got a few $100 million in revenue. What so dramatically happened that this is, they're going to get their act together over the next decade?
Okay, a couple of things. First, management team. The founder, Therese Tucker, is very much a product person. She's been managing the business ever since she founded it in 2001, rather. The company did go through an acquisition. They were bought out by a private equity owner a few years back, ultimately went private. During that time, they converted the business from an on-premise to a fully cloud-based SaaS solution. So that certainly added to the quality of the revenue.
Okay. John Paulson, unmute yourself, John. John, unmute yourself.
Yeah, thank you. Can we go to page 19 where you have the income statement, I believe? My concern is that you look at the net income, the sales projected for 21 and 21, yet the operated loss, even though the sales almost doubled, 20 lost 19. So just feel very skeptical. 5 years from now, they'll make 178 million. When Bill says they've been in business for 20 years, I don't know.
For some reason, you're breaking up a little. Can you talk a little bit louder?
What gives you the confidence that they'll go from 19 million in losses in 21 to such wild profitability?
Yeah, a couple of things. First, on kind of the GAAP accounting, the company capitalizes a good chunk of upfront kind of sales and marketing expenses, especially when they use channel partners to sell. And they also have a meaningful stock-based compensation component that depresses the GAAP numbers. On the kind of non-GAAP adjusted operating income, the company has been profitable for the last 3 years.
And why do you ignore stock-based comp? Why is that not a real cost?
It's certainly a real cost in terms of shareholder dilution. For our purposes, when we looked at the DCF, we actually assumed all of that gets bought back. It's not an ideal way to do it, but it's one of the mechanical ways that we can hit cash flow.
But if they didn't compensate with stock options or restricted stock, whatever they're doing, wouldn't they have to pay people in cash? Right. So isn't the economic effect both a hit to the profitability of the company and to the dilution of shareholders?
That's correct.
Okay. Other questions? Meredith, how much time we have left?
We have 4 minutes and 25 seconds.
Okay, next question.
Hey guys, just a quick question on customer concentration. I saw somewhere in your presentation that SAP controlled about a quarter of the company's revenue. What is the nature of that relationship? Obviously, they're like a dominant ERP player. Is there any risk of them kind of stepping in and disintermediating them?
Deeksha, are you on mute? Sorry.
I know. Could you please, you kind of broke up for me.
His question was, according to this page, SAP is 24% of the company's revenue. What's the risk of SAP kind of taking over this business, or either losing that customer, or SAP develops a module that does what these guys do?
Right. So like you pointed out, it does bring in 24% of the revenue, but we don't really see this relationship as a risk because it is balanced against its merits. Like on a positive note, this helps the long-term margins because SAP manages most of the support and client servicing based on their fixed fee. So BlackLine doesn't really take the risk of excessive client maintenance costs. And on the upside, SAP can seek to acquire BlackLine. The current management team is the team that drove NetSuite to $1 billion of revenue, ultimately selling it. And our industry conversations, they did cite rumors of potential SAP sale as, one of those badly kept secrets. So, but if anything, given our views on the business, we actually worry that a premature sale would prevent public investors from actually realizing the long-term upside that we see in BlackLine.
Okay, other questions? Okay.
Just one question from me while we have some time left. The 2030 valuation from your DCF I saw was like an implied multiple, like 25 times EBIT. I didn't see in your presentation kind of the projections beyond 2025, but what are revenues and earnings growing at, in 2030 when you're using that multiple?
Yeah, absolutely. Revenue is growing at high teens, and earnings are normalized towards a 25% free cash flow, and it's approximately high 20% kind of EBIT margin.
Okay, and what gives you the confidence, that revenue could continue to grow in the high teens, 10 years from now?
So we've kind of, this is a good slide to switch to in the appendix. I think slide 40, Song, if you don't mind. And so when we looked at kind of how companies are thinking about adoption in the long term, we found that there's kind of a snowball effect happening with regard to the benefits that businesses are able to realize with automating a lot of their kind of back office functions. And so we think as that continues to grow, businesses are going to more broadly accept the benefits, the value that is being created. And this is going to, again, I think this ties to our point where the company will become not a nice to have like it is today, but really a must-have solution for most finance companies, for most finance organizations.
Okay, thank you.
Okay, why don't we go? Thank you so much. Excellent presentation. I think we should keep moving, Meredith.
Yep.
And I apologize, I may drop off shortly because I'm fading. So I'm going to hand off to Anthony Massaro. Anthony, if you see me disappear, please take a look for me.
Yeah, absolutely.
Thanks, Bill. Okay, next up we have Team 4, Dolby.
All right, guys, get going. Let's go. Team 4, where are you? Are they muted for some reason? What?
Hey, Paul, are you there?
Meredith, are we letting these guys in? What are we doing here?
Well, they're in. I don't know if they're having technical difficulties or what's happening.
Yeah, I just saw David.
Sorry, the Zoom has crashed on me, so let me just reshare again. My apologies.
No problem.
Is that better?
Yes, we can
Yeah.
see.
Okay, thank you so much. Okay. Thank you so much for your time today. We are Paul, Jack, and David, and we're pitching a long on Dolby Labs. It's a $10 million licensing company. They develop audio and visual IP and license it to the media industry. And so the market of their tech includes 1, content creators, so music, movie, gaming studios, even individuals now. 2, streaming services and distributors. And 3, manufacturers of consumer devices. They currently only monetize their IP through device manufacturers on a per unit basis. So when an electronic device gets shipped, the manufacturer pays a royalty. They trade around 6.5 times consensus revenue or 16.5 times consensus EBITDA on a 2022 basis, which we think is an attractive entry price. We think Dolby can grow 2.5 to 3 times in 5 years. They've historically been a standards-driven business. So Dolby's patents are virtually a requirement for audio playback in consumer devices. And therefore they collect a toll from manufacturers because manufacturers need to use it. And this is the business that the market has historically focused on. But in recent years, management has made a major strategic shift. On top of this strong recurring revenue-based business, they've now also built a suite of next generation consumer-facing audio and visual technologies, namely Dolby Vision, which is a high dynamic range visualization engine, and Dolby Atmos, which is 3D spatial sound. And this has fundamentally changed the business model because now they get to exploit indirect double-sided network effects. First, they incent content creators to master content in Dolby. Then, because there's so much content, consumers will seek out devices that can play back that immersive experience. And finally, because consumers have the devices and demand it, studios are reinforced to master their content in Dolby. And we don't think the market fully captures this shift in business strategy, where device manufacturers now want to include Dolby because it drives incremental sales of their SKUs. So our thesis is fourfold. 1, this business transformation has made Dolby a better business. 2, an adoption cycle is just starting and Dolby will be able to sustain growth above consensus. 3, there's a ton of hidden operating leverage in the business, which is going to multiply the effect of this growth. And 4, the network effect approach bolsters and sustains their competitive position. So first on the business transformation, Dolby's been able to prove itself over 50 years of technology cycles. In the early 2000s to 2010-11, Dolby decided they were going to ride the DVD wave. They became the standard in all optical drive players and resultingly licensed their way to 22% compounding top line with 60% incremental margins, which was amazing. The problem with this was by 2010, well over half of their revenue was from optical drives, a derivative of DVDs. And so when DVDs died, they suffered. And they did a nice job of kind of containing the damage in the years after, but really any incremental growth was getting cannibalized by decremental DVD sales. And we think the pain from DVDs is finally over, and the underlying business was always very strong and with great margins. And so for simplicity, we're dubbing this underlying business New Dolby. And New Dolby bundles hundreds and hundreds of individual patents into these consumer-facing brands. And we think they have a long runway to monetize their IP, at least through the back half of the decade. And they're going to have to continue to increment R&D and sales to keep their products relevant and competitive. What we'll show later, we believe they already have a cost-effective model for doing that.
So the secular trends of increasing internet speeds and processing capability make it possible to bring higher quality audiovisual experiences to the home. These trends will drive the rapid adoption of Dolby's technologies and deliver revenue growth of 15% per year. The growth in Dolby's addressable market is led by the mobile and broadcast segments, and it is in these markets where we think Dolby will be most successful in gaining share. Historically, Dolby's share of industry revenue for both mobile and broadcast has increased by over 10% per year, and we expect that to accelerate due to the upcoming adoption cycle. When looking deeper at mobile and broadcast, our market analysis outlines the growth opportunity for Vision and Atmos that we think will drive double-digit revenue growth. Existing customers will expand their usage of Dolby technology across their entire product lineups, moving beyond just the premium SKUs, and new customers will adopt Dolby technology due to its superior performance and powerful network effects. Apple is a great example of this adoption journey, With Apple, we think Dolby is breaking ground in their latest new product introductions. For example, the iPhone 12 is the first smartphone to enable video capture in Vision, and we expect that other OEMs will follow Apple's lead and further adopt Dolby's latest technologies.
So underneath a seemingly flat business with contracting margins, we believe is a hidden gem. It didn't make a lot of sense to us that a majority 95% gross margin licensing business with no real competitors would have declining margins unless something else was going on. And we tested a number of potential explanations, but we believe their pain has all been due to this legacy DVD business. And if you normalize out DVDs using management point estimates and global shipment data of media players, we see that a strong underlying business was in the background, and it's been growing 15% top line with almost 60% incremental EBITDA margins. And when we decompose the remaining business on a per unit basis, we think most of the embedded fixed cost scale comes from deleveraging on R&D and sales and marketing. They will continue to have to invest in these areas as they seek to keep their products market leading and relevant, but this is a good thing. And we think they can still get these close to 60% incremental margins with that operating model. So finally, here are some recast financials that underpin our analysis, and just a depiction of how much more efficient we think this new Dolby marginal cost structure is than their current average cost structure.
What makes us comfortable with the long holding period of this business is just the durability of the business model they've created. Before, they were much more tied to audio-based standards and encoding and largely tied to the film industry. But now they've done a great job of diversifying the media they're incorporated in and the product that they bring to market. Their product portfolio now includes these premium products that we've mentioned before, Atmos and Vision, but it also includes Dolby Voice, Dolby Cinema, and now even a nascent API business in Dolby.io. And effectively what they've done is create across a wide range of media formats, created double-sided network effects, all the way from content creators to device manufacturers. So that content as sophisticated as a movie, or as simple as just an individual mastering their audio in SoundCloud, passes that through to distributors like Netflix, and ultimately gets consumed on your end device, your Samsung TV or your Apple iPhone. And so we think that these double-sided network effects create significant barriers to entry, but we would also argue they create a tremendous amount of value across the entire ecosystem. For example, it benefits Netflix. Netflix was able to create a premium tiered service where they can charge $4 a month more and enable previously unenabled 4K video, Dolby Vision, and Dolby Atmos enabled content. Second, the focus on providing a more bundled product offering creates higher switching costs for their OEM customers. And third, Dolby has a lot of important proprietary technology, but we also think they have really effective ingredient marketing. And it's kind of like Intel Inside. When you see that Dolby logo, you know you're about to have a premium audio and video experience. And so what that means for valuation is really just what we talked about. So we anticipate key drivers of returns to be the growth in mobile and broadcast revenues, supported by significant margin expansion over the next 5 years. We also believe there could be additional upside if use cases within gaming, music, and auto accelerate growth in their corresponding end markets faster than we think. And importantly as well, we project all these returns to be driven by revenue and earnings growth, not multiple expansion. And so our variant perception really stems from our primary research and unit analysis, which just suggests that there's still really long runways for revenue and margin growth. And then especially on margins, we're comforted by the fact that last quarter, Dolby achieved 40% plus EBITDA margins. And we just think that this margin improvement is here to stay because again, this is a licensing business. And then just last, given the durability of this business model and the growth runway that we just described, we think Dolby is an extremely attractive risk reward with additional option value if some of the less certain lines of business really start to take off.
The most exciting one of these opportunities is Dolby.io, which is a newly launched API business that allows developers to integrate high-quality audiovisual IP into their applications. Management believes the TAM for Dolby.io is equally as large as the core business that they operate today. An API business would bring in new customers, such as software developers, into the Dolby ecosystem and generate revenue from usage instead of device sales. We expect management to disclose more details on this exciting new opportunity in the near future.
And then just finally, as it relates to risks, we feel that investors can be easily deterred by the nature of Dolby's bundled contracts with customers that span multiple technology products in multiple end markets. But we think in a way that this bundled relationship creates a lot of value for Dolby and really just points to their durability and stickiness with their customer base. And with that, thank you, and we look forward to your questions.
I have a question. Can I
Please,
go?
go ahead. Yep.
Thank you for this presentation. I gotta just say, from on a personal perspective, I've been alive as long as Dolby has existed, and I've never understood what this elusive tagline has been. So your presentation actually helped me. It was actually a teaching tool. So what I'm trying to understand is there's so much mental complexity when it comes to understanding these different layers of superior audio and imaging, and they are constantly improving. And now, I know Dolby is in the AirPod Max now, and what I'm trying to say is, from your perspective, have you spoken to consumers, or have you found any sort of consumer research that basically ranks where superior audio and imaging lies in their purchasing decisions? Because you're layering more and more now onto their purchasing decision. So, like, is this something that is just an automatic purchase, or is there sort of a group of very sophisticated consumers that go out of their way and say, I'm only gonna buy a product if it has this Dolby license attached to it?
Yeah, that's a great question. And I think certainly it took us a little while to start to understand the business as well, we would say. But so as far as, where Dolby typically sits, I think historically it's been very much at the premium end of the SKUs. And so they're in 9 of the top 10 smart TV makers, but not all in all of the cheapest SKUs necessarily for Atmos and Vision. And so really what they're starting to do is that's starting to take a little bit more mainstream. We would point to Apple, with call it put up on the screen here, as like a really key success for this premium technology coming more to the mainstream. And so over time, Apple has kind of come all the way in on Dolby's technology, which Jack talked about a little bit earlier on the iPhone. And so what we've seen over time is just the product stacking that they've done, to the point where now you can capture vision footage on your Apple iPhone. So part of that is data speeds, which I think we have a slide in the back talking about some of the trends that are starting to kick off too. So part of that is data speeds and processing power with this. And part of it is also just the premium services starting to launch. So I think one thing that we've seen a lot over the last year in the media industry has been the launch of the higher tier products. So Spotify introduced Hi-Fi a couple of months ago. Amazon Music HD actually released their HD version, and now they actually have an Echo speaker that includes Dolby Atmos directly in it. They advertise and co-brand with Dolby. And so we think that this kind of shift towards premium products is really important. And when you talk to the way that the Dolby management team kind of frames it, their biggest hurdle is it good enough, right? Is the audio and visual experience, is it good enough? Like, is this really a big part of my purchasing decision? And do I care about this? We point to indirect wins with customers as a key success story for this. And on top of that, just the proliferation of some of these premium streaming services.
So wait, so let me just understand this. So you're saying that actually having a Dolby attached to a product does sway the customer one way or the other? I mean, that's never really impacted my purchasing decision. My real question was, do you have any data points on Dolby as a brand impacting a purchasing decision of one of these products?
I don't think we have data on like what is the incremental willingness to pay for a customer for the Atmos brand versus not. But I will say that when we talked to some of the equipment manufacturers, when they said like their direct quote, I think, was, if you're not in immersive sound unless you have Atmos in your product. And I think just there's a general trend towards increasing customer demand for better and better technology. And as that drives the industry forwards, it's almost inevitable that Atmos will continue to make its way into more and more customer end devices.
Yeah, and sorry, one more thing just to add on that, maybe it's an anecdotal evidence, but like HBO Max has started doing a lot of co-branding with Dolby on Atmos and Vision products, and the customer awareness being increased for big releases that are kind of coming direct to consumer now rather than kind of going to the film studio or to the cinema.
I mean, sorry, the reason I'm just really harping on this issue is because they have a rock solid balance sheet. So you're trying to sort of see where the revenue can go. Where can they, how can they accelerate the revenue? Is there any branding opportunities? So great, thank you. You've answered my questions.
Other questions from the judges?
Can you guys talk about the work you did to get comfortable that incremental margins are actually 60%? And then separately, can you just walk through how pricing works in their mobile business?
So maybe we take the second one first, which unfortunately we don't have like the actual per unit price for each feature Dolby provides within an Apple iPhone, for example. They don't disclose it. It's a trade secret of theirs, and it's a competitive secret. We think, based on anecdotal evidence, it's somewhere between $1 and $5, depending on the device and depending on the integration. So not a material part of their cost structure. But then when you have, they do a declining block rate essentially. So the first million are X amount, the next million after that are X minus 10%, and so on and so forth. So if you get a customer like Apple, who has a lot of unit shipments or volume shipments, they can drive that average price down over time if they're able to integrate it into more and more devices.
Yeah, and the last thing we'd say too, when we talk to Dolby IR, just confirming the way that they kind of think about go-to-market, is it really is just one Dolby, right? So they do have multiple products and they do have this bundle, but when they're going to Apple, who we just showed all the different product lines that incorporate Dolby, they really are negotiating their licensing contracts in a really nuanced way. And in a lot of ways, sometimes the patent pools that they participate in, their customers are also like in the patent pools with them. So really nuanced relationships that make it challenging in some ways to understand the cost. But we can do back of the envelope and get comfortable that it's not really crushing margins the way that you might think that it would be. And it actually is a significant value add service, even if you can just mark up price incrementally very small relative to the cost.
And to your second question on the incremental margin piece, we did that analysis and it seemed to have really great explanatory power for us. And so what we decided to do is go back a cycle and check against, what were they able to do during the last boom. And we found that the incremental margin profile was a little higher, but very similar. And even though that they've changed their go-to-market strategy, their actual operating model itself, we don't believe has changed too much. And so just as a sanity check of whether our forecast incremental margins make sense, we just kind of brought it back and tied it to something they've done in the past.
Great. Jillian, did you have a question?
Yeah, I did.
Please.
Yeah, so I think this is a good company. I've owned it since about 2012, just simply because it's had a great entry yield and IRR. It's definitely now more of a consensus long. It's definitely more contrarian at the time that I was invested in it. It sort of fits in, it certainly fits into my new fund 221B in terms of the secular theme, bottom up fundamental. I guess the concern I would have, I mean, it's obviously generated sort of 150% cash flow conversion. Is there any sort of nearer term issue with respect to semiconductor shortages, given what's going on in the industry and they're tied to unit economics? Or perhaps you can talk to the sales cycle that maybe cushions them from that. Thanks.
Yeah, no, it's a great question. And I think when we look at 2020 as a comparable year, we kind of saw some of those backlogs affect their revenue on a per unit basis. But on the long run, we still feel very strong about the kind of secular growth for this. And I think part of what gives us a little bit of confidence is just, we think that they've invested a lot in R&D and they have a pretty significant brand value. And so I know there were some talk about the balance sheet before, but we formulated the balance sheet with what we estimated to be kind of just the cost of the brand value, and still see like a pretty nice cushion on potential downside for whatever that could be. So we think that long term, these trends are still here to stay. But yeah, there's certainly an acknowledgement that on a per device level, if you're shipping less devices, that could be a consideration.
And to your point, the sales cycle is quite long. To negotiate the contract, get in bed with the chip manufacturer, go, talk and get your brand co-branded in the actual equipment manufacturer. And so we think that there's not as much disruption to their actual sales process. Obviously, they're a unit volume-based business, so we've seen that in their financials. But, if things come back and semiconductor backlogs start to work through, we don't see any reason that it would be, actually impair the business all that much.
Yeah, and I think in talking to some of the OEM partners, especially on broadcast, like the cycle for these things, they quoted 10 years about. Mobile's obviously a lot faster, but gave us a lot of confidence that there was runway.
Great, thank you.
Great, I think that's Meredith. I think we're out of time, right?
Yep, that's perfect. Thanks, team. All right, last team, Pegasystems. Whenever you guys are ready.
Good evening, judges. Kyle Wemble and I are pitching a long position in Pega system with a 5-year price target of 310, representing a 20% IRR. We believe Pega is a strong buy. It offers a differentiated product in an under-penetrated market. The transition from perpetual to subscription will improve business quality, particularly Pega cloud offerings. And recent management changes will enhance business operation efficiency. So Pega is a enterprise software solution, and it offers 2 types. Back office solutions help business to automate and streamline processes and improve efficiency. Front office solutions helps, for example, call center staff to have one-on-one interaction with customers that can drive sales and improve retention. Pega was founded 40 years ago, and it has grown into an international business with over $1 billion in sales. It has deep and defensive industry expertise in financial services, insurance, telecom, and healthcare. For example, 7 out of the top 10 global banks are Pega customers.
Pega empowers large companies to achieve breakthrough results in both saving costs and generating revenue. Some examples are listed here. Notably, Google is among them. Although Google has the world's best software engineers, Pega's expertise in complex field management and real-time decisions still creates great value for them. Whenever there's an outage on Google network, Pega's dispatching module will jump in and select the most operationally efficient resource based on 500,000 roles. Pega mainly competes in 3 markets: business process management, robotic process automation, and client relationship management. These markets are competitive and rapidly growing. BPM is what Pega has been best known for in the past 15 years. The narrowly defined BPM market is maturing, yet the growth will be largely coming from the local platform where business analysts without any coding experience can use drag and drop tools to build applications. The RPA involves bots that mimic human actions to automate repetitive rules-based tasks. So RPA is the future of workforce and is expected to grow 5 times in 5 years. And lastly, CRM mainly helps manage customer data and customer interaction. And in this market will continue to grow at 18% CAGR. Then our first thesis is that Pega is among the leaders in a fast-growing industry. The TAM is around 80 billion, of which 50 billion are serviceable for Pega, considering client size and verticals. And this serviceable market will grow at 18% CAGR. Penetration opportunities still present in most Pega's existing clients as well. According to Gartner, Pega is a clear BPM leader and is also among CRM leaders. In emerging subsectors like low-code and RPA, there's still no clear leaders now, and Pega is visionary to grow capabilities towards first quadrant. Moving on to competitive advantage, Pega sustains a unique position with high retention products. It's been most successful in competing for global companies because of its unified architecture, flexibility to choose between private cloud and Pega cloud, and a vertical specific solution. These are all crucial in addressing pain points of businesses involving a high degree of change, complexity, or regulation. Pega also differentiates from major competitors like Salesforce by providing complex workflow management, real-time precision, higher ROI, and smooth integration. This supports Pega's dollar retention of 115% in contrast to Salesforce dollar retention of around 90%.
Pega's transition from perpetual software sales to a cloud-based subscription model is creating a higher quality business. First, revenue growth has accelerated during the transition, despite the nature of GAAP reporting skewing top-line optics. Perpetual software sales are recognized as revenue upfront, whereas in the subscription model, revenues are recognized over the life of the contract. The timing lag results in what appears at first to be subpar performance. On the left, it's shown that Pega has been growing revenues at 19% for the 10 years leading up to the transition, and then seemingly has fallen off in the last few years. However, a more reliable indicator for recurring revenues is the growth in annual contract value, or ACV. The formula at the top right breaks this down, but basically the ACV is the amount of revenue that's going to be reported each year. Over time, revenue and ACV growth will begin coinciding, which is encouraging, as ACV is currently growing more quickly at 22% CAGR. The main driver here is the exceptional performance of Pega Cloud. Pega Cloud ACV is growing at a 60% CAGR during the transition, with growth accelerating in 2020 versus 2019, despite starting with a higher base. Currently, this line of business makes up about 20% of total revenues. However, demand continues to exceed expectations, with some partners we spoke to estimating 90% of new bookings are Pega Cloud. And the strong performance and sustained demand will push the revenue mix towards Pega Cloud, which we think becomes about 60% of revenues in our exit year 2026. The key takeaway here is that this mix shift results in accelerated top-line growth during the last phase of the transition and beyond. Moving down the income statement, the maturation of Pega Cloud, as well as other operational improvements, will lead to margin expansion. Historically, Pega's trailed peer margins due to an underdeveloped partner network, which resulted in a significant portion of revenue mix coming from low-margin consulting services. We'll touch on this a bit more shortly, but our primary research demonstrates management's well aware of this and is taking tangible steps to improve. Additionally, as Pega Cloud has yet to reach scale, the investments in the development of the platform have weighed on the product's gross margin. Established cloud software businesses often have gross margins exceeding 75%. Pega Cloud's ramping quickly. Gross margins improved 1,200 basis points in 2020 from 51 to 63%. And during our conversation with Pega's CFO, he mentioned they'll be above 70% soon and above 75% plus when they exit the transition in 2022. We agree that this is possible, but our base case conservatively scales Pega Cloud gross margins to 72.5% by 2026, and the net result is an overall gross margin for Pega around 79% at our exit.
Support Pega's transition from perpetual to subscription. Pega had a plan. It more than doubled the sales and marketing headcount in the last 5 years, and it switched the reward incentive structure to reward based on annual contract value instead of total contract value. And Pega managed to keep the sales marketing per headcount down. However, when we're looking at incrementally speaking, Pega wasn't great, especially with the sales efficiency. In 2018, Pega spent $3 to gain $1 in ACV, and that gradually increased. To tackle this issue, Pega had a plan. It first hired Hayden Stafford from Microsoft. During his time at Microsoft, Hayden managed to grow Dynamics sales from $1 billion to $3 billion. And Hayden had a plan of experienced industry professionals from IBM, Salesforce, and ServiceNow to help him execute. Step 3, leadership reshuffle. In the most recent 8K filed in March, all the go-to-marketing functions are now centralized and report directly to Hayden. Once you have the right structure, you can tackle the problem. Pega plans to retrain all their sales force and hope to reduce the sales cycle. And finally, as Kyle mentioned before, they hope to expand the partner ecosystem. Through our primary research, it costs Pega 10 to 20 cents to gain $1 extra in partner sales, much more if product productive than the direct sales team. As Pega involves partner in the sales process and let them build applications on top of Pega platform, we're expecting to see tangible improvements in sales efficiency. As a result, sales and marketing as a percentage of total revenue will decrease from 52% to 39%, and EBIT margin will expand from -6% to 21%, which is still below the mature SaaS business margin of high 20%.
On slide 17, you can see most of the value creation comes from Pega Cloud and term licenses, which is Pega's client cloud offering. Client cloud still continues to be a differentiator for Pega, as it allows customers to choose to host their own cloud if they'd prefer, and we think there's some demand for this in the medium term. However, overwhelmingly, Pega Cloud provides greater benefits to customers in the form of reduced costs, better flexibility, and predictability. If we take a look at the different valuation cases, we think Pega offers significant upside from our base case. So our base case price target of $310 is based on 7.5 times 2026 revenues, which assumes the multiple contracts slightly, approaching its 2-year historical average. However, looking at the scatter plot on the right, you can see that despite showing a superior growth profile to peers, Pega trades at a significant discount. From our conversations with the sell side, Pega is viewed as a legacy software solution, not a cloud-based subscription business like Zendesk or ServiceNow. As management executes on its vision, the business transition is completed, and Pega Cloud continues to grow, becoming a majority of the revenue mix. Pega's valuation will reflect this. In our bull case, we think this translates to a 10 times EV to revenue multiple and an IRR of 34% over 5 years.
So one of the risks is the timing of completing the cloud transition. Through our primary research with IR, CFO, and the broader investment community, they are confident at Pega reaching the goal. However, we have built in a 2024 date into our bear case. So Pega has a terrific product, a sticky customer base with a clear path to the future. It's a visionary challenger in the SaaS space that can generate 20% IRR with an upside potential of becoming a five-bagger. Thank you so much for your time, and we are open for questions.
Great, thank you. Why don't we turn it over to the judges for questions?
I guess a question for me, typically, this is on the model, typically what you see during a cloud transition is that license revenue decelerates and potentially goes negative, both for license and maintenance. I'd be curious why in your model, license revenue would accelerate. And if license revenue were to accelerate, why wouldn't maintenance?
Sure. So in terms of the revenue acceleration during the transition, Melody, if you want to go to slide 53 actually, we have a little case study that we've done on Adobe. And so as you can see, Adobe is kind of the benchmark for excellence when doing one of these kind of transitions. And on the left-hand side, we compared the revenue growth that Pega has experienced versus Adobe. Adobe went through this in 2012, going from perpetual to SaaS. And Adobe did experience negative revenue growth. However, Pega's actually performed better than Adobe during the transition so far. And so they've had no years of negative revenue growth, and they're exiting the transition on a trajectory very similar to Adobe. And then on the right-hand side, you can kind of see how that affected the multiple in the marketplace. The multiple expanded almost 120% following this transition. And so we think that really that's one of the reasons why they haven't seen it up to this point, and they're on the back half. They're about 65% of the way through the transition. And so really they're just kind of wrapping up and closing down, and we'll be done with the transition in 2022. And so as far as the question on maintenance goes, we do have maintenance continuing to grow. However, the maintenance with the term licenses are going to be a lower amount of the business. And so it's really a function of the mix shift to Pega Cloud, as well as the fact that there is no more perpetual sales and term licenses become that lower piece of the pie.
I had a question. It's a really good sort of well thought through case study. The comparison that I would have made is like Guidewire and also SAP, who also went through the transition with HANA. We owned Guidewire from like 2012. There was a lot of misunderstanding both on the sell side and the buy side as far as the impact of the transition. And what we got the company Guidewire to do was to come out with sort of a rolling fourth quarter recurring revenue metric model. Have they done anything in terms of the metrics that they're reporting just to make the understanding easier? How's the communication with the street, because it's challenging for sure, and not everyone understands it.
Yeah, definitely. I think they're going through that re-education process right now. They've been very public about talking about annual contract value and trying to shift the focus onto this as opposed to top line revenue. In some of their investor days, they've kind of given guidelines as to how even annual contract value is broken down versus like a traditional contract. So they really give that detail, and they've even done, as the revenue standard changed in 2018, was the same year that they were going through that transition. And so they really pointed to how everything used to be recognized up front, and now even the difference between term and Pega, or Pega Cloud, sorry, excuse me, and that kind of rolling forward, how it's going to now be recognized over years. And so that's kind of where that disjoint happens, where it's just, it leads to this misunderstanding if you don't dive into the details of it.
Got it. Thank you.
Yeah, this is John Paulson again. Seems got a good presentation, but my concerns again are on valuation. Just going to the beginning of your presentation on page 5, if we can go there for a moment. Yeah, there we show an enterprise value of 11.4 billion, and then latest 12 months EBITDA of lost 122 million. So this seems like a very risky situation where perhaps they can turn things around, but you're paying an enormous price, taking enormous risk. I don't really see. Maybe you can tell me where the value is here. It seems like, to me, I would say this is extremely expensive turnaround. That if you can't turn the business around, or it doesn't turn around, potentially lose a lot of money here.
Sure. Yeah, I'm happy to start with that one, and then maybe somebody else can chime in too on some of the business turnaround. But in terms of the valuation, so some of the adjusted EBITDA or EBITDA is still impacted by this transition. So it's not, the revenues hasn't quite picked up. They did have accelerating revenue growth this past year at about 11%. We think that as they exit the transition, again, that Pega Cloud piece is becoming more of the business. And so it's going to grow kind of much more quickly with that. Thanks for pulling this up, Melody. So the chart here on the right shows really why we think that this is misvalued. Again, you can argue that the marketplace has a lot of rich multiples, and it certainly does. But on any way that you kind of look at it, Pega is below the peer set here. And Melody, if you go now to slide 51, and actually to try and kind of think about how this might look on a mature basis, we applied mature margins to our exit year revenue. So that's what we have here in this justified multiple column. We have our exit year revenue. We think a mature EBIT margin is about 25%. Again, when we exit, it's about 21%. So there's about 400 basis points of expansion there. This translates into a 40 times PE multiple, which yes, that's definitely still high. However, baked into that is another 5 to 10 years of growth where when we exit the transition, they're still growing at about 20%. So as that growth tapers off into mid-single digits, that's baked into the multiple. One thing to support it on the right-hand side, we've got a basket of about 35 software companies. You see that the margins are kind of in line looking 3 years out. So that helps get closer to maturity. And despite the margins being in line, the multiple is actually significantly lower, both on an average and a median basis. So that gives us some confidence. And then finally, one last point, if you look at the historical multiple column, all these assumptions are exactly the same. However, prior to the transition, Pega traded at a PE multiple of 27 times for 9 years. And so if we insert that 27 times multiple into our assumption, you walk away with a 5-year IRR of 11%, which is slightly above the market rate. And so even as a kind of an alternate downside case, we think our bear case is very conservative. This is kind of another alternate way to think about it, that even if they execute operationally very well, but the market doesn't readjust and doesn't give it the valuation that we think is justified, you still walk away with an above market return.
Yes. So to add on the business performance aspect, looking at the management team, the company is very much founder-led, and we're seeing that the Alan Traveler, the co-founder and CEO, he owns almost 50% of the business. So he has a lot of skin in the game. So and the CEO is really taking the company into the right direction by hiring Hayden Stafford. And I also want to point out that one of their CFO, their only CFO, Ken Stillwell, he has over 25 years of industry experience. And particularly before he joined Pega, he was the CFO of Dynatrace, and he successfully led the transition for Dynatrace from perpetual to SaaS. So he is not someone who's very new to the job. So he will be able to bring this new operational experience to Pega. And we just want to highlight that before March 2021, he was only the CFO, but now he's also the COO, which really signaled the management and the board of directors' confidence in him.
Great. Other questions from the judges? I guess I'll ask one myself. If you can go back to the implied 40 times multiple, and one issue I have with this one is, if you look in your terminal year 2026, like stock-based comp is like half of your adjusted EBIT, right? So the multiple is not really 40 times, it's 80 times. And I don't see you kind of deducting stock-based comp in your discounted cash flow analysis on page 48 at all, like kind of when you PV the unlevered free cash flows. So I guess, how do you think about stock-based compensation, given it's a dramatic, 50% of what you're treating as earnings here, and it's a real cost to the business?
Yeah, completely agree that it is a real cost. And one way that we've handled that is to account for it in the dilution side of things. So we've taken account share-based dilution that kind of takes out and eats into the IRR. But to Bill's point earlier, it is a real expense. I think that one thing I would point to is that all of these companies kind of trade on these adjusted earnings multiples right now. And so if you're kind of looking at that and trying to think about in the peer set, kind of people are at different stages. Some people are further along in their development, some people aren't. This way to kind of compare and make this comparison is intelligent, because you can kind of cross-sector analyze where these companies are. Though I agree that in the long run, it's going to be a cash expense and that will affect it. But hopefully, as they continue to grow and kind of break out of this, reach their hiring needs and develop that sales and marketing force, it kind of tapers off. We haven't accounted for that in our case, but certainly that could be a possibility.
Okay, great. I think that wraps it up, right, Meredith?
Yep, that's perfect timing. Thanks so much, guys. So we're going to take a quick break. The judges will deliberate. Judges, you have the link to the deliberation room in your email. So I will see you over there soon, and then hang tight. We'll be back with the winners. Thank you.
Okay. Meredith, should we get started? You want to give a minute for?
Yep, I think it looks like most people are logged back on. So Anthony, go ahead.
Great. So first of all, thank you to our 5 finalists and to everyone, who's participated, in this competition and the other rounds as well. We were gone for a while because, we thought all 5 ideas were excellent, great presentations, very well researched and great delivery, particularly in a Zoom environment. It's just not as easy as being in person. And, we recognize that and applaud everyone for the job they did. I think it was a close call, but at the end of the day, we do have to pick our top 2. So our runner-up this year was Angie. So congratulations to that team. And then the winner was Dolby. So congrats to the Dolby team. We're going to be splitting the prize money. $100,000 will go to our first place team, Dolby, and $50,000 will go to our second place team, Angie. Congrats to both teams. Phenomenal presentations, and if hopefully the prospective returns are as good as last year's, because I know last year's winner, we just checked, is up over 100% since it was pitched, which is great. So congrats to our winners. We encourage you to think of the Heilbronn Center in terms of giving them kind of a revenue share here. And why don't I turn it back over to Meredith?
Great. Thank you so much. Thank you, Anthony. Thank you to the Pershing team, to the judges. Many congratulations to the student presenters. You all showed Columbia Business School very well, and we appreciate it. And thank you very much to our audience. We really do hope to see you in person in 2022, but in the meantime, we'll see you online. Our next big event is the From Graham to Buffett and Beyond virtual Omaha event, which we'll have Mario back on. Looking forward to that May 1st, right before Warren goes on Saturday afternoon. So thanks again to everyone and have a good evening.